All right, good morning, everyone, and welcome back for our 10th episode of Equity Explorer. I'm Karina, a global equity investment specialist at Fairtree, and I'll be moderating today's discussion with Gavin, one of our analysts. So, just to give you guys some insights on Equity Explorer, ultimately it was designed as a teach-in on key themes in equity markets, offering deeper insights into industries, companies, and trends that are shaping global investments. So our goal here is to give you guys the tools to better understand the forces that are driving markets and to potentially highlight opportunities. However, please do note that this is not financial advice, nor does this represent a deep dive into our portfolios. We would be happy to set something up with you guys if that is required. With that, I'm really excited to introduce today's discussion on the global oil majors, where our analyst Gavin will explore some of the key macro forces shaping the outlook for oil. Please feel free to send through any questions during the presentation, and we will try to answer as many of those as possible at the end. With that, let me hand over to Gavin. Gavin, thank you so much.
Thanks, Karina. I appreciate the intro and welcome to everyone on the call. I'm looking forward to discussing oil with all of you. Maybe just a brief comment from my side before I get into this. We're not going to get into too many of the technicals today on oil because it gets super technical really quickly. But we did think it will be interesting to share some of our thoughts and findings on such a relevant sector. So yeah, if you guys do have some more technical questions, feel free to send them through and we'll follow up with you guys offline. But for today's discussion, we're going to try and keep it a bit lighter, with a lot of focus on the macro because it's so important, and then just touch on the majors, where they are, how the valuations look, etc. So on that, let's say the first section, we're going to run through the macro and geopolitical overview for oil. And then when we're done with that, we're just going to get into some of the majors and some of the key differences, etc., etc. So just on the macro and geopolitical overview, we're going to talk through why it's so important to understand the commodities and the correlation with share price and earnings. Russia and Iran, we're going to talk about OPEC and some of the sentiment changes we've been seeing over there. The US oil independence, which is quite a big shift over the last 2 decades. Peak oil, which is quite interesting because historically, about 20 to 30 years ago, this was way before my time, the discussion was actually around peak oil supply. People worried that there's not going to be enough oil. And that's actually shifted into a peak oil demand worry. So it's interesting how the world changes. And then just on refining, we'll get into some of the nitty-gritties there. It's been quite an interesting space. And I think for me, it's one of the more interesting spaces within oil because it's one of those things where you see it every day. You use petrol, you use diesel, but you don't necessarily think about the process, and that everyone talks about crude demand, but it's actually petrol and diesel and kerosene, etc. demand. So it's interesting. We'll get into that. So yeah, let's jump in. So maybe just this graph over here. Let me just get my pointer going for everyone. The orange line is just, let's say, the sum of all the EU majors' net income forecast for the next 12 months, and then the oil and gas price. So a 2/3 weighting to oil and a 1/3 weighting to gas over time. And you can just see how tightly these are actually correlated. So if oil and gas prices go down, your net income forecasts go down. And if they go up, your net income forecasts go up as well. So that's why it's super important to understand the underlying commodities, because in the end, that's by far the biggest driver of earnings. And as well, your share prices are going to follow your earnings over time as well. So this is a slightly longer period. And you can see there are periods of slight divergence. But in the end, it's very directionally accurate that if oil and gas prices are going to go up, so are the oil and gas stocks over time. So that's why we focus a lot on the macro. And I reckon this is 80% the macro call when investing in these global oil majors. So on the macro side, maybe just starting on the demand side. Um, so one of the research houses that we follow, it's named Gavical Research. They have a really a statement which hits quite hard, where they say that economic activity is energy transformed. So in essence, that means that if economic activity is strong, the demand for oil and gas and other, energy products is going to be strong, and vice versa. So if the economy is going to be weak, and you can see that, so the shaded areas in this graph over here indicate recessionary periods. And then you can see how oil demand trends lower year over year during those periods. So if the economy is weak, you're probably going to see some pressure on oil demand. And that's historically been, one of the biggest drivers of oil demand. And you can see COVID was a bit of an anomaly, and oil demand was under a lot of pressure over here. But today, there are many other risks and opportunities which we need to take into account. So we're going to touch on some of the big ones. There are a lot of other factors also at play, but trying to keep it interesting. So let's maybe start off with Russia and Iran. So how important are geopolitics to oil? Super important. And the big reason is that a lot of the oil production sits in slightly less geopolitically stable regions. So Russia accounts for more than 10% of global oil production, slightly more. So, Russia is actually quite important to take into consideration. I'm pretty sure everybody knows that by now. It's been a while since, Putin decided to invade Ukraine. And it's actually surprising that it's taken so long. So some of the interesting things that came out of the war and its impact on oil. So maybe just for some of you that don't know, so you get different types of oil. So you get crude oil, which is the oil most people refer to. Then you get WTI, and you also get Urals. So Urals is basically the Russian crude. So when we talk about Urals, it's basically Russian crude, which has slightly different characteristics than, let's say, WTI and Brent. But it is actually quite a high quality crude, where if you take Canadian crude, is low quality because it's very heavy. So you don't get a lot of, when you refine it, you don't get a lot of petrol or diesel out of it. Where Russian crude is actually quite nice. You get very high diesel yields out of Urals. And that's why you can see that the discount that Russia, let's say Urals, trades at to Brent is actually has been quite low historically. So let's say before the invasion, it was between $0 and $5 discount. Well, let's say with Canadian crude, it's about $10 to $20 depending on the different environments. But then what we saw after the invasion, that a massive discount was placed on Urals. And that's due to sanctioning and price caps, because Urals' natural home used to be Europe. It's quite close. All the refineries are actually set up to refine Urals, etc. And that discount actually lasted for quite a while, but we've seen this discount close. And one of the reasons is that as Brent crude prices have dropped, the effect of the $60 price cap on Urals has become less pronounced. But then also, Urals have found a new home. So if you look at this chart over here shows where Russian crude exports used to go to. So in the early 2010s, it used to go all over the place, but Europe was a very big import. And then you've seen China grow quite a lot in the mix, becoming a bigger importer of Russian crude, but that's also due to the fact that the economy has been growing a lot, their crude needs have been growing, etc. But the more interesting one actually to see is what's happened to India's imports of Russian crude. So after the invasion of Ukraine and the Urals dropping to such a big discount, India has made a massive step up in the amount of Russian crude that it's been importing. And two reasons for that. Firstly, India is not a part of NATO. So for them to import Russian crude, it's a bit easier to get over the line, and they're supporting one of their BRICS partners. So a bit of geopolitics at play. But also, India's refineries are actually well set up to run Urals through their refineries because of the quality of Urals. And because of that, the the drop off in Russian overall crude production has actually been much more manageable than most people initially thought it was going to be. So you can see that okay, COVID was a very big disruption, and then it started to improve. And then in 2022, you can see that when they invaded Ukraine, initially quite a sharp reduction in crude oil production. But if you tell me 3 years ago that Russian crude production is only going to drop roughly 10%, which is this drop which you can see over here, I would be very skeptical. And because of that, they've still been able to fund the war machine with their oil exports. So, that's forced the West to adapt its strategy a bit. And that's to a large extent why Trump's been calling for secondary tariffs on importers of Russian crude. With India being slightly more susceptible to damage than China, I don't think China would be too worried about it. And you could actually see on the day that Trump announced these secondary tariffs, I think oil jumped about 6 to 7% just because of how big India has become in Russia's export mix. And that, if it's not going to India, where's it going to go to? So it could be a bit of a supply challenge. And then you've also seen the Ukrainians target Russian refineries as well. But we'll get into that into a bit more depth later on in the presentation. And then another geopolitical fact to take into account is Iran. So although Iran's not as a big producer as Russia is, so they're about 3% of global oil production at about 3 million barrels per day. And there are a lot of sanctions on Iran, and there's always a lot of talk about sanctions. Most of this crude is basically black market crude, which finds homes in, let's say, non-West countries. But the bigger issue with Iran is actually not their own oil production. It's the fact that this strait between Iran and the UAE exists. And because Iran can basically close off the strait during periods of, let's say, a lot of geopolitical tension. But more than 25% of the global crude traded flows through this strait because all the Persian Gulf produced oil needs to get through the strait. I see this as more of a tail risk. I don't think it's very likely that they close this. There have been talks a lot about it this year, especially with the war in Gaza. But I think Iran would be shooting himself in the foot if they'd close that strait, because they'd be causing a lot of economic pain, which will probably see the West ramp up pressure on Iran, which would just be unnecessary for it. So tail risk definitely, but I don't see it as too likely. But time will tell. You never know. The Middle East has been pretty volatile this year. And then just quickly to talk about OPEC, so the Organization of Petroleum Exporting Countries. Over the last couple of years, been some interesting observations over here. So the first one is that over the last decade and a half, you've actually seen OPEC lose quite a lot of market share. So they've basically gone from just below 40 to just above 30% of global oil production. And a big reason for that is the US shale revolution, a massive uptick in US crude production. But then also you've seen lots of other non-OPEC regions, especially in Latin America, start to increase oil production as well. And there've been quite a lot of significant finds over there. So we should expect this supply market share to continue to be under pressure unless Saudi Arabia decides to pick up their oil production by quite a bit. We'll see. And then after supporting the oil market in 2022 and 2023, it does look as if there's been a bit of a sentiment change at OPEC. So you can see this graph illustrates OPEC spare capacity. So if spare capacity goes up, the amount of produced oil typically goes down. And you can see that in 2022 and 2023, there was quite a sharp uptick in this. Um, but the sentiments definitely changed over here, and you can see this starting to roll over. And then maybe just to go into a bit more granular detail on it. Just to explain this graph over here. So the black lines over here show OPEC's production guidance, and caveat, they don't always produce exactly what they're guiding for, but it does, it's sort of an indicator of directionally where they want to go. And then you've got the orange line, which is your oil price over here. And then you can see that OPEC were producing about 30 million barrels per day in early 2023, while oil prices were below or between 80 and 90 roughly. And trying to keep prices above 80, you can see that they actually cut production guidance over here, trying to keep supply away from the market, supporting prices. And you can see that, they were definitely in a mode of supporting oil above 80. They don't want oil to go below 80. And an interesting reason for that is that the moment oil goes below $85 per barrel, Saudi Arabia starts turning into a fiscal deficit. And Saudi Arabia is basically the kingmaker of OPEC. And it's not because they're they're the low cost producer globally of oil, but they're spending a lot of money. So, they've got a lot of elaborate projects which they're spending money on, and they need oil prices to be high to be able to spend on that. But what's been happening within OPEC is this graph basically shows, let's say, the actual production versus, OPEC guided production. And after a period in 2022 and early 2023, OPEC was actually producing less than what they were guiding for, because a lot of the countries with highish quotas were struggling to produce oil, of which Russia, I think Nigeria was also one of those who were struggling. But then they adjusted it, and then it changed. So from 2024 onwards, the members have actually been producing more than what they should, with Kazakhstan, I know, being quite a big culprit over here. Where the Saudis have always been, pretty disciplined, and they were the member to take the biggest cuts. So it's basically like in a cartel or a gang, some of the lower members basically just disobeying the kingmaker or the don. And because of that, well, that's one reason at least, there's definitely been a sentiment shift within OPEC that even with oil prices, heading towards 70, 75, they've started to increase production. With, a lot of talks about oversupply going into the beginning of 2026, etc. And, I think a big part of this is just to, make sure all the OPEC members stick to their production plans, because Saudi Arabia can adjust their fiscal spending to a large extent. And they can, manage oil at 30, 40, they're still making money off of their oil. It's just the fiscal stuff which needs to be sorted out. So there was a lot of talk about the fiscal balancing of Saudi, but it does seem that they are willing to take a bit of pain over there. And look, the Saudis have a super strong balance sheet. So if they need to lend a bit of money, that's also okay. And then maybe just another reason for OPEC being a slightly more aggressive with their production hikes is the rise of US shale, because there was a lot of US shale capacity coming on, even above 75, even at 75 to $80 per barrel. And then the moment you start going to 60, 65, that does come under a bit of pressure. So slightly less supply from US shale as well. So definitely a shift within OPEC. And then I think this is also quite an important topic, which does sort of touch on it as well, is the US energy independence, which has a quite large geopolitical ramifications, but it's also super important for the oil market and how to think about it. So the US shale revolution started in the late 2000s over here. And you can see that after a long period of declining oil production, the US oil production has just hit a massive leg of growth. And that's largely due to shale. And this has seen the US turn from the world's largest importer of oil to becoming a net exporter of oil. So they're producing more oil than they actually need, which does make the US energy independent. So might not need to invade Iraq again just to get oil price, to make sure that oil prices don't stay too high. And then just looking at the US strategic petroleum reserves, this was interesting as well. So when oil prices spiked after the invasion of Ukraine, the US tried to keep the oil, tried to, suppress the oil price by releasing some of their reserves. And they were quite aggressive in doing it as well. So they released quite a lot of reserves over here, and they've been quite slow to build this reserve back up. And this is, this does add a lot of marginal supply or marginal demand over time. And the reason that, let's say, the shape of this graph looks like this is because the US has a lot of oil, which is just sitting below ground and is actually economic at the moment. If they need to extract more oil, they can just drill more shale. So this does, make it easier for the US to buy and sell oil in their strategic reserves, which I think, it's a positive for the US to a large extent, because it definitely does take away from OPEC and the Middle East's grip on the oil market. And then maybe just something on US shale as well, is that it does look as if there is some support for oil at $60 per barrel. And the reason for that is at the moment oil heads to roughly $60 per barrel, you start seeing a notable decline in the amount of new shale projects coming online. The current projects will continue to run because that capex at the start's already being spent. But because US, let's say, shale wells last 12 to 18 months, it's quite a quick, let's say, decline. And if you're not replacing those every 12 to 18 months, it's a drop in the total supply. Where if you look at offshore rigs last multiple of years, it does, the supply response is actually quite quick from US shale, which looks to be at about $60-ish per barrel. And then just quickly on peak, well, we're not going to get into too much depth on this. You could probably spend a whole session on this as well. But just want to highlight, two key things over here. So if you look at, this graph over here shows, let's say, oil demand under different scenarios. So the scenario at the top with the blue dotted line basically shows what will happen to oil demand if your per head or per capita usage of oil stays the same and the economy and population just continues to grow. So there's a natural, let's say, driver behind oil demand going forward. As the economy continues to grow, you need more energy to convert to be able to generate economic activity. And then these diamonds over here is basically on the bottom of the graph is basically the IEA's net zero scenario. So just to show how big of a difference there is between, net zero and just normal state at the moment. And to be able to reach these net zero targets, you're going to have a viable alternative for energy, and also profitable. So there's a lot of work which still needs to be done over the next 25 years to be able to get to these net zero targets. And what is quite telling and interesting to see is just what you've been seeing at some of the majors. So these are specifically the European majors, which have been spending on renewables because there's been a lot of ESG pressure, etc. And after 21 and 22, you can see there's a massive ramp in spending on renewables, but it actually looks already off peaked in 2024. And the reason for that is that these companies aren't making money with the renewable projects, which makes it very hard for them to invest in them because, it's easy to call for ESG until you start not making money anymore. And then it becomes tough. shareholders want a return on their investment. So, it's been interesting to see, and we'll get into the different majors, let's say, approaches on it. But BP and Shell have been selling out their renewables projects because they aren't making money. So it does bring into question how viable those net zero targets are. And there's a lot of work and a lot of money which needs to be spent to be able to get there. Then just on refining, again, as I mentioned earlier, this is something which I find quite interesting. I think just because, as I mentioned earlier, you see it every day, but you don't necessarily make that correlation when thinking about, okay, crude oil demand, but oh well, it's actually diesel and petrol demand. Because before oil becomes useful, it needs to be refined, so you heat it up, and then basically at different temperatures you get different byproducts, or distillates is what they call it. But then you've also got different supply and demand dynamics for those different products. And because your cost per barrel of crude is the same if you generating naphtha or petrol or diesel, but the demand for diesel and naphtha differs, makes that you get different margins for each product. So let's say if you theoretically distill a whole barrel of crude, and you get a whole barrel, and you pay $80 for that, and you get a whole barrel of diesel out of that, and you sell that for 150, and you're making $70 on that distillate. And that's basically the product crack spreads. And what was interesting to see after the Ukraine invasion is how these crack spreads for the different products diverged. And a large reason for that is that there wasn't enough diesel. So refineries had to refine more oil to generate more diesel. But the demand for fuel oil and naphtha didn't go up because those are insets into industrial processes which didn't go up or down by that much. So you saw, you're actually selling your fuel oil and naphtha at a loss, but that was then being made up by extremely high spreads for diesel because there was a massive shortage specifically of diesel. And that's explained by the next graph. So this is a busy graph, but I'll quickly explain. So these bars basically show the excess amount of, let's say, distillate per region. So you can see the former Soviet Union generating about 1.1 million barrels of diesel per day, more than what they actually consume. And historically, this was quite easy. So they just exported all of this diesel to Europe, which you can see is actually short diesel, which means that they are a natural importer of diesel. But then when the conflict happened, Europe didn't want to import Russian diesel anymore. So they had to go find diesel somewhere else. But what made it very interesting is that there was no other natural place for Russian diesel to go, because Asia is a net exporter of diesel, so they didn't want Russian diesel. Africa already gets its diesel from the Middle East and Asia, and North America sells its diesel to Latin America. So that basically meant you've got this 1.1 million barrels of diesel per day, which can go nowhere. But your demand for diesel didn't necessarily change that much. So then Europe had to compete against Latin America and Africa for all of this other export diesel. And that's a big reason why there was just a massive supply and demand imbalance. And you saw those crack spreads spike, which is just fascinating to see. And everyone thought that that's going to balance out over the next 2 or 3 years. But what we're actually seeing in 2025, so if you think about this cracking margin, this is, let's say, the combination of all the different products. So if you distill a barrel of oil and you go and sell 20% worth of petrol, 30% worth of diesel, 10% worth of jet fuel, and then the rest of the products, this is the margin that you're making on that entire barrel of oil. And you can see that in 2025, this has been extremely strong, which very few people expected at the end of last year going into this year. And what's been interesting is the reason that this has happened is that Ukraine has been attacking Russian refineries with their drones. So they've been more than 30 strikes so far this year on Russian refineries, putting this market, which is already turned onto its head, under even more pressure. Um, I'd be surprised to see this calming down soon. This is a super interesting graph on the right over here, which basically shows that 75% of Russian refining capacity sits within striking distance of the Ukrainian drone, which is about just over 1,000 miles, so 1.6 kilometers. So they're definitely spending quite a lot of money on anti-drone technology in Russia at the moment, because this is a key part of their war funding machine. Um, so super interesting. And that's definitely something to keep an eye on, because there are a lot of businesses who make a lot of money out of refining, of which Sasol is also one, as they do have a refining part in their business. Cool. Then quickly, just going to run through some of the interesting things we're seeing at the majors at the moment. So after a period of underperformance in, let's say, 2019, and into COVID, of course, the MSCI World Energy is basically a basket of oil producing companies, actually put in a really nice leg of performance. People underinvested in oil over here in COVID, and because of that, there was just not enough supply, and demand jumped back much faster than most people thought it would. Then another nice decent leg after the Russia-Ukraine war, and then since that, let's say the oil stocks have been roughly flattish over the last, let's say, 2 years, as oil and gas prices have normalized. Where the rest of the world, it's been a good year for the stock market, especially after Liberation Day. It's done really well. So it has been underperforming a bit, and largely due to the fact that oil prices have come under pressure, which I think a big part of that is just due to the fact that OPEC's changed its mind about how much capacity it wants to keep back. And then within the majors, you can see that they, sitting decently on the cost curve over here. So they're still making money even if oil goes to 60. With Total being the most aggressive about high grading their portfolio. So they sold a lot of their assets down. So all of their high cost assets, they basically tried to sell down so that they can sit with the best assets that they have at low cost, which just makes them a bit more resilient under different oil price macro environments. And ExxonMobil also did a good job in that, also quite low on the cost curve. Shell and BP and Chevron slightly higher on the cost curve, but still they're very far from being the marginal producers. Then another thing which is quite important to take into consideration is the differences in reserves. So 1P is basically proven reserves. So you can see that Aramco is by far the strongest player over here. They've got reserves for a very, very long period of time, which means that they don't necessarily need to spend that much money on exploration over the next couple of years, because they already know where their oil sits. They basically just need to develop it. Within the other majors, two standouts just worth mentioning are ExxonMobil and Total, where they, have been looking after reserves, continuing to invest in exploration, and due to that, their reserves are sitting in a more healthy space than, let's say, Shell, Chevron, and BP. And just honorable mention for Total, they've been doing this while they've been spending on renewables capex. So they've been balancing the two quite well, and they've been very consistent in their approach. And then just mentioning this was something that in 22 and 23 was really topical, is just how different the approaches have been by the US majors and the EU majors. So it's been more of a drill, baby drill environment for the US majors, with not all of their shareholders, but a lot of their shareholders being more supportive of them doing their thing. If you're investing in Exxon, you're investing in an oil company, so go drill for oil, go produce oil. leave the wind farms to someone else. Where in Europe, there's been a lot more ESG pressure on these companies, and a lot of them have caved. So you saw Shell and BP, announcing a lot of renewable projects. Total, even before this massive ESG pressure started, Total's already been investing in these renewable projects, and what was interesting as well is that even when the ESG pressure came along, they didn't increase the amount of money they were spending on renewables. So they've been very consistent. Where BP and Shell, they've had to turn things around a bit, being a bit going too much with the tide, I reckon. And then just on the EU, just to show the renewables success has been mixed. So Total has, considerably more installed capacity than the rest, and that's due to the fact that they've been much earlier to the party. This graph might not show it, but they're also making more money off of their renewables portfolio. So they've been very strict with their IRR targets and assumptions, which has made them by far best in class. So they're already generating almost close to 50 gigawatts of capacity, which is basically almost the entire South African grid. So it's impressive. And then, although this graph is slightly dated, you can see that this pipeline for BP over here looks quite large, but they're selling down a lot of these projects because they aren't making money. And they've also, both Shell and BP have had management changes, strategy changes to focus back on oil, just because they've been losing money with the renewable stuff. It's an interesting development. And just like a bit of a shout out to Patrick Pouyanné. He's Total CEO. He has been for a long while. He's been super steady and consistent with his strategy, which is definitely noteworthy. Then just looking at the valuation. So we try to look at free cash flow yields. The earnings can be quite volatile and there are a lot of adjustments in it, but in the end, the cash is king. So we try and look at the free cash flow yields of the different majors. So you can see Aramco over here trading at quite a big premium to the rest of the companies, with the ExxonMobil also having quite a nice premium. And you can see over here that the EU majors are trading at a bit of a discount to the US majors. And what's been nice is because over the last 2 to 3 years with the high oil prices, lots of free cash flow being generated, all of these companies have paid down a lot of debt. So the balance sheets are all in really good spots. And they're basically paying out every cent of free cash flow as either dividends or buybacks. So about roughly 60% dividends, 40% buybacks. And they tend to up the buybacks. If you're going to see a nice rally in oil, that your buybacks are definitely going to make another step up. They're basically paying out all of their free cash flow to shareholders, which is quite nice to see, and wasn't always the case. They've historically been spending a lot of money on exploration, etc. But it seems that they've balanced that quite nicely of late. So it's quite nice for us as shareholders. If you're buying Shell, you're going to get 10% worth of divvies and buybacks while they're maintaining their portfolio. And then another important thing just to consider is that the companies which have higher growth prospects also tend to trade at a premium. And you can see that specifically with ExxonMobil and Chevron, that Exxon is trading at a premium to Chevron at a lower free cash flow yield, but it has a considerably better growth outlook over the next 5 years at least. So if you take the growth into account, they're actually trading at parity to each other. And that's roughly the same with the EU majors. If you take the growth into account, Total actually starts to look cheap versus the rest. And then Aramco is a bit of an outlier because they've got these massive reserves, which is also just something to take into consideration. It's a big reason for why they're trading at such a premium. And they've also got they're the lowest cost producer globally. And then in this graph, it's also quite interesting to see that Exxon, or let's say the US majors, are trading at a big premium to the EU majors. I think there are a lot of ideas being thrown around as to why that is the case. I think a large part of it's due to the different shareholder base. And you can see that a large reason, I think, why a lot of these EU majors want to move their listings to New York is due to this premium that the US guys are trading on. Um, but also, I think Shell and BP specifically are a bit in the dog box because of their strategy changes. Shell's already turned the corner, so it's looking much better for them. BP is still pretty new in their new strategy. It is looking quite encouraging at the moment, selling stuff which isn't making money, focusing on the right things, changing KPIs to focus on, let's say, oil-specific things. Um, and it is quite interesting for me to see Total basically being the cheapest of the lot because they've been super consistent in what they've done. Um, and it's definitely a really well-run business. And yeah, that's all from me for today. Thanks so much for your time. And I presume we're probably going to have a question or two.
Brilliant. Thank you so much, Gav. Let's kick off with some questions that have come through. So just on the first one, why is Saudi Arabia calling for an increase in production quota despite it driving oil to below their fiscal break-even point of $80 per barrel of oil?
Yes. Yeah, I did touch on it in the presentation, but firstly, it's the strong balance sheet which Saudi Arabia has, which makes their fiscal um, deficit easier to manage. And then apparently, historically, this is some of the notes that I read, is that they're quite agile with their fiscal spending. So they can actually turn the taps on that. I think they have this wall city thing which they're building, which I presume is probably spending on that's going to be cut back quite a bit over the next couple of years, until you see oil go back up again, etc. But for them, I think the most important thing is keeping the rest of the OPEC members in check, even if that costs them a bit of money in the short term. And that's a super important development, I think, which has happened over the last year and a half in terms of sentiment and the dynamics of the oil market. Yeah, I hope that makes sense.
Brilliant, thank you. And then quite a few questions coming through on Sasol. So maybe given Sasol South Africa's only real oil exposed stock, what does all of this mean for Sasol? And just some views and comments around your thinking there.
Okay. Firstly, I'll disclaim that I'm not the official Fairtree Sasol analyst, but I do follow it very closely. Um, so I think. Maybe let's just start with the oil price. I think the fact that the Saudis are willing to increase production, even in the face of some oversupply going into next year, probably does put a bit of a cap onto where oil can go, without the massive shock. Because you've already got a lot of shocks worked into the base. And then on US shale, the fact that you're starting to see supply coming off at 60. So I reckon that you're probably going to be, again, this is only my opinion, you're probably range bound in oil between 60 and 80, I reckon, which is not, it's, yeah, not a disaster for Sasol, as at least they're still making money sort of with oil at like 70, 65-ish. But what does offset that to a large extent is the strong refining margins. As Sasol is very diesel heavy in their refining slate, so that definitely does support their ability to generate free cash flow. Look, Sasol's been their own worst enemy over the last while. With some production issues, yield issues. And I know that they've been talking a lot about that destoning project, which, if I recall correctly, in the last result actually looked, it actually looked like it does seem to be turning the tide somewhat. Still a lot of show me in the story. But I think that's could be a nice upside ticker for them. But then the key thing for Sasol, though, is the petchem market, which I didn't touch on in this presentation. I'd probably need another hour or two if I were to talk through petchem. But a lot of Chinese capacity coming online over the last couple of years, which has put the market under pressure. So petchem margins have been, under a lot of pressure. Demand for petchem's been quite weak, while the supply has just been coming on. So I reckon that the refining does offset a lot of the problems which you're seeing at Sasol at the moment, but there are a lot of Sasol specific things which they need to fix as well. It's my take on it. Again, disclaimer: I'm not the official analyst on Sasol.
Brilliant. That was perfect. Thank you so much. And then maybe just one more question to squeeze in. I know we've gone over time here. Over the last 2 years, oil companies have outperformed the underlying commodity. Do you have any insights into why that's been the case?
Well, they've been buying back a lot of shares, which helps, and they've changed their balance sheets have been strengthening as well. And you also had a period where they were underperforming the underlying commodities. So it's basically a reversal that they're making up for that underperformance by outperforming now. And then also they've sharpened up their dividends and buyback policy. So they're being much more shareholder friendly at the moment. So you're getting nice yields when you're buying these companies at the moment, which I think is supporting them during a period where your underlying commodities have been slightly weaker.
Brilliant. Thank you, Gav. Any questions we haven't gotten to as yet, we will get back to you via email. And yeah, just from my side, a big thank you, Gavin, for the really insightful presentation. And to the audience, if you have any further questions or would like to reach out about our portfolios, please feel free to contact myself. And yeah, thank you all again for joining. We will see you in December, where we'll be discussing the Indian macro environment and some of those financial companies. Awesome. Thanks
Cool.
so much, everyone.
Thanks, everyone.
Bye.